From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday the 1st of October, 3 p.m. in London, 10 a.m. over in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel is over in New York. Welcome, everybody, to Bloomberg Markets. Alix, they can't make up their minds in D.C. They can't make up their minds on Wall Street, it seems, today.
100% really choppy just in the last few hours. It was a terrible closeout to September yesterday and that third quarter. And today we're really chopping around. On the one hand, you get very high inflation. The title of my board is party like it's 1991. You had the Pce indicator at the highest level since 1991. You had stocks kind of rolling over as well. The Dow managing to hold on. You got Merck rallying the most since 2009. So that helping the Dow there. Yields pretty much go nowhere, but off the highs that we've seen over the last couple of days. Dollar finally getting a break, down 0.2%. But the question is always going to be what happens with the supply chain and power prices. We'll discuss those two things throughout the next couple hours. Natural gas may be getting a bit of a break here, but the path of least resistance seems to be higher, and that's going to have severe implications all across the board.
Absolutely. Let's talk about what is happening in the manufacturing sector, because certainly it is being affected by those issues you raise. We get ISM manufacturing. The data has been disappointing of late. This is positive. So ISM manufacturing, the headline number 61.1, that is up from 59.9. The survey 59.5. Prices paid though, Alix, and this is where life gets interesting, up to 81.2. Wow. That's up from 79.4. The survey was 78.5, so an expected dip. We're at 81.2.
Yeah, and the other orders here, new orders for ISM coming in also strong, 66.7. So that's interesting. You have these higher prices paid, but the new orders sticking strong. And employment coming in pretty much bang in line with estimates and sequentially also higher. So first blush, it seems like a relatively strong read, but we want to dig deeper here with Tim Fiore, ISM Manufacturing Business Survey Committee Chair. Okay, so Tim, what was your biggest, walk us through the numbers. What stood out?
Yeah, thanks, Alex. So, hey, demand is still rocking hard. I mean, really, really good. Not only was the new order number level really high, but the backlog stayed up near record highs. And customer inventory levels are still at record lows. So, absolutely positive. The production side employment was, kind of similar to last month, performed relatively well, but still has a lot of headroom to move. The story, again, was in the input side, and we actually did some reversals here in terms of suppliers having more difficulty in delivering and prices going up again following 3 or 4 months of softening. So that's the bit of a disappointment there. But the inventory counts maintained a high level. A lot of work in process inventory that's being held up. A lot of finished goods now being held up along the supply chain. But really good report.
Yeah, it's interesting. We were in the 90s on the prices paid, but we picked back up into the 80s. These are still stratospherically high numbers, Tim. Let's talk a little bit about kind of where the bottlenecks are right now, where we're seeing the constraints. If I take a look at the PMI data that market produce, they can see them pretty much everywhere. They're seeing certainly it acting as a restraint on the manufacturing sector's ability to satisfy the demand. What are you seeing? How do you compare and contrast the picture when it comes to supply and demand?
Well, chip issues remained 10 to 12% of my total general comments, up from the prior month. It seems to be getting worse. I think the predominant opinion is that this is going to continue into half two of next year now. I think there was a lot of hope that we would see Q1 improvements, but it's starting to get a little bit more pessimistic about that. Hurricane impacts are now coming back into play on the plastics market, primarily polyethylene, polypropylene, packaging materials for sure. And steel prices are stubbornly high and just will not budge. So a lot of headwind here, a lot of exhaustion on the purchasing side. So we've got the triple play really going on. We've got long lead times, we've got more and more shortages, and we got increasing prices. It's really an operations manager's nightmare.
Yeah, but Tim,
it's where we really shine.
But Tim, new orders are the highest that we've seen. Well, it was same to August, but also then the highest that we've seen since March, and the backlog of orders is still quite high.
Yeah, it's fantastic. It's excellent. I mean, we just keep driving more and more demand, and it just keeps kind of building up there as reflected by the backlog. So labor issues are still there. About 3% of my employment comments indicated that they're getting a little bit better in September compared to August. That's not much, but in August it was 0. So still had 83% of my employment comments looking to hire, and about 40% of those were expressing difficulty, which was up 3 or 4 points from the prior month. So the same issues continue, although there was 7 million people came off the unemployment rolls in the month of September. Not sure that we saw the big benefit of that in September, but hopefully we'll see more and more of that in October and November.
What do you think next month's numbers are going to look like?
Well, I don't see a softening in demand at this point, and as long as lead times keep getting pushed out, the new order rates are going to continue to accelerate. So I'm hoping that we'll see some relief here on the employment side, get that number up to high 50s, and see the production number jump up into the mid 60s. I would expect that at this point with this kind of demand, and we just can't seem to get there. And then consequently, I would hope that maybe the inventory count would come down a little bit, and supplier delivery number would come down too, as suppliers are delivering better. That's what I'm hoping for, but I'm still expecting a very high, PMI in the high 50s, low 60s. I don't see any reason why that wouldn't be the case for October.
So, Tim, what I find interesting is that the stagflation conversation seems to be taking a deeper root over in Europe and in the UK as well, with their PMIs that were released today. Is this a potential stagflation scenario, or is it something different? Because if orders stay strong, then growth should continue.
Yeah, absolutely. I don't see any reason why it won't. So far the earnings calls are very positive too, that the price pressures have been able to get passed on to clients. So that's all good. At some point though, in my opinion, really on the labor side is that it's now mixed, because at some point not being able to bring people into the workforce is really going to slow down demand. And I think we're kind of at that point, but I'm hoping October will see an improvement.
Tim, what we've been talking about a lot over the last few days has been congestion at container ports. And a lot of that seems to be driven in the run-up to the holidays. Once we get through the stocking ahead of the holidays, do you think that's going to free up capacity and actually make some of these input cost factors, input availability factors become a little bit more easily as we go into New Year?
Well, I think it's going to help. I mean, we knew that this would be a peak period for port entries and container offloadings, but part of the problem too is that Southeast Asia continues to have shutdowns, which means they're not shipping reliably into the U.S., which means they're ending up sitting on boats and all that confusion. I think we thought that the ocean freight situation wouldn't get resolved until post Lunar New Year, and we're probably looking now at the first half of the year, probably July, before the port issue kind of fixes itself, because there's a lot of mispositioning of containers and chassis, and that's going to take months to fix. So even if the demand starts to back off, getting all the equipment in the right spot again to get back to normal is probably a quarter. So the ocean freight issue is going to remain a problem through the first half of next year.
Tim, it's always great to get instant analysis on this data. It makes sort of understanding the numbers so much more useful, so much easier, and therefore the whole process so much more useful. Thank you very much indeed. Tim Fiora of ISM Manufacturing Business Survey, the ISM Manufacturing Business Survey Committee. Greatly appreciated. This is Bloomberg.
Lots of other stories out there this morning that are moving equities in this choppy market. ISM numbers was one of them, but there's a lot of other data as well, personal spending, as well as income. I want to get right to Bloomberg's Michael McKee with a roundup of all the numbers you need to know. I did spend, apparently.
Well, thank you.
You're welcome.
Your country thanks you. Guy and Alex, though, hold on to this debate about inflation or reflation, because inflation is the story today. We're looking at the personal income numbers. They come in better than expected, up 0.8 for the month after a revised decline of 0.1 in the month of July. These are August numbers. And the spending numbers come in a little bit, they come in at 0.4 on 0.8 for spending. I'm sorry.
There you
Getting
go.
confused
It's tricky.
here.
It's
Anyway.
Friday.
Here's the bad news. The bad news is that the spending numbers are not adjusted for inflation. Adjust them for inflation, and they were only up 0.4. And in July, there was a 0.5 decline. So for the quarter, we are seeing a very, very weak consumer spending number, and people are marking down their GDP forecasts because of that today. The other number that comes out in this release is the Pce Price Index, which matters to the Fed. Oh, well, let me point this out. I forgot I threw this in here. This is wages, and this is transfer payments, and you can see how the economy has shifted. Wages are still rising. They were up 0.5%, but the transfer payments, the government payments for the COVID relief, down from a 23% increase to a 2% increase on the month. So we're shifting the mix of incomes. All right, now let's talk about the inflation numbers. The PCE inflation numbers, obviously not particularly good news for the economy. We're looking at 4.3% for the PCE headline, and now we're at 4.3%, 4.6% for the core. Inflation is rising to where the Fed doesn't want it to be. It just keeps going up. It's a little bit slower pace, but it is still not good news. And what I want to show you here is the University of Michigan sentiment numbers. Now, they came out just a short time ago, a slight rise in the overall sentiment number and a slight rise in expectations and present situation. But what everybody's been looking at with Michigan is the inflation numbers. And you can see the white and blue lines are where they think inflation will be. The white line is next year, and this is in 3 to 5 years. And this is that PCE number I put in there. So you can see that inflation expectations are rising as inflation rises over the next year, but they're not over 3 to 5 years. So the Fed has to decide going forward whether this is an inflation problem or just a short-run reaction to the headlines, because they don't want inflation expectations to become unmoored. Discuss.
Transitory or not? There we go. Mike, thank you very much indeed. Mike McKee on the data and some fantastic charts. Let's turn our attention to what is happening in D.C. The Democrats may have averted a government shutdown late last night. Nancy Pelosi still working, though, to get a vote held today on the infrastructure legislation.
We are proceeding in a very positive way to bring up the bill of the BIF, to do so in a way that can win. And so far, so good for today. It's going in a positive direction.
So they're caucusing, which sounds like a lot of fun. Anne-Marie Hordern is here. She's got the inside track as to what is going on. What's the latest?
Well, there will be caucusing, Guy, in just about 17 minutes' time. They're meeting at 10:30 Eastern Time, the Democratic Party. And what Speaker Pelosi said yesterday, leaving the Capitol around midnight, was that there would be a vote today. She also promised to vote on Monday and yesterday on Thursday. There's one little wonky legislative process happening here. She didn't actually gavel out. So technically on the legislative calendar, it is Thursday, but we all know it is Friday, and they are past this deadline. What they're trying to get negotiated between the progressives and the moderates is some sort of middle ground where the progressives are willing to vote for the bipartisan infrastructure, which at the moment they have succeeded in really holding hostage and the feet to the fire of the moderates to say we need to see movement, real movement on reconciliation, or we are not going to vote for that hard infrastructure bill.
Yep, I love the gavel thing. That's actually amazing. Thank you for bringing that to us. Bloomberg and Hordern, thank you very much. So that's one big risk, is how much money is really going to come out of D.C. The other risk is what's happening in the energy/power/gas market, particularly over in Europe. Technically and potentially, it could get a lot worse this winter. That's according to Bank of America. The bank predicting now that diesel prices could actually top $120 per barrel, and Brent could actually move past $100 per barrel, depending on just how bad the winter is. Bloomberg's Isis Almeida joins us now with more. Isis, it's a two-pronged question, right? Do we get to these numbers? Like, how bad will it get? Or are we so priced to one side of the trade right now?
It's so hard to say right now. I think we are priced to one side of the trade, but, you know, China just basically launched the war onto the global energy markets. You know, they're going to buy cargoes of coal, LNG, or gas, or any energy products are basically at any cost. So that just leaves, you know, demand now to like do the job of bringing down prices. You know, it's going to have to be demand destruction if China is all out there.
As a Brit, I love talking about the weather. Is that where we're at now? Are we all going to become amateur meteorologists? Is that going to be the focus this winter?
Absolutely. You're definitely going to be watching the weather and hoping it's mild and hoping it's windy so that we can actually get some wind power going on.
Yep.
And I think that would be really key to getting us through the winter.
Yep. It's going to be interesting to see who is the best meteorologist, because they're going to be in demand.
You always
Isis,
talk
great
about
stuff
the weather.
as ever.
This will literally be
I'm
no
British.
different.
This is what we do. This is perfect. It's going to be fantastic. I get to talk about the weather off air and on air.
And
it's
I
going to be
can't say
amazing.
anything.
No, you can't. We're good. Is it mild today? Is it not mild today? These are now critical market factors. Is it raining outside? Is it, as Isis says, is it windy? This is big stuff. Let's talk about what is happening with Merck, Alex. The stock up massively. The company announcing that it's going to seek emergency authorization for its oral COVID treatment. The phase 3 trial showing it basically this pill reduces the risk of hospitalization or death in COVID patients by a staggering 50%. Joining us now, Bloomberg Opinion's Max Neeson. Max, how big a breakthrough is? How big a game changer could this be?
A pretty enormous one. I was very happily surprised by the results, which both came sooner and were of a greater magnitude than I expected, given what we've seen from antivirals for both COVID and for other viruses in the past. The thing that makes it such a big game changer beyond, obviously, the very impressive results is the fact that pills fundamentally are easy to make in large quantities relatively quickly, relatively cheaply, and then very easy to distribute. It can be at your local pharmacy, at a clinic, rather than, to contrast with antibody therapies, which require dosing at limited sites and through a complicated process. So potential to be very widely available and widely used, and then widely manufactured, maybe getting around some of those equity and supply issues that have plagued the vaccine rollout and bringing needed relief to a lot of people. So incredibly promising and exciting.
All right, Max, thanks a lot. Really appreciate it. Max Neeson joining us there. Thank you very much. Hey, Guy, we have some interesting numbers coming out here in terms of Tesla. We're actually waiting for the third quarter deliveries, but Bloomberg has noted that potentially they're going to be record of about 224,000 in the most recent quarter. That would be another huge milestone for the company.
Yeah, I'm waiting for data to hit the screens. Like, it's due about now. They calculate it right up until month end, so we hopefully will get the data now. The stock has been a massive underperformer, which is worth bearing in mind when you consider what is about to happen. These are potentially strong delivery numbers coming through, but it's not been a great run, and you've seen what Cathie Wood's been doing. She's been selling the stock pretty aggressively.
Yep, and you also have to deal with the chip contagion, the storage issues, container issues, shipping issues, all of that. Plus, you have all the European automakers as well as Ford and GM, like really ramping up and throwing billions of dollars at their EV strategy. And we just interviewed the Lucid CEO, Peter Rawlinson, earlier this week. I mean, their cars are rolling off the line here, not as much as Tesla, but like Tesla kind of did the work, and now Lucid gets to kind of capitalize on some of that existing infrastructure, and they're rolling off the cars.
Yeah, and now that you can't buy petrol in this country, maybe an electric car sounds like a pretty good idea.
How? You have to plug it in somewhere. It's all related.
Yeah, but so the lights, there is still electricity, there just isn't petrol, gasoline.
Right, but those are different things. But still, like if the power prices are so high, are you really going to want to plug in your car? I don't know.
Yeah, you plug it in the middle of the night. Maybe you get a slightly cheaper deal. We're going to talk about what Cathie Wood is up to. Up next, ETF Friday. We're going to take a look at what she's been doing. Her flagship ARC ETF suffering its first quarterly outflow ever. That story next. This is Bloomberg.
Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. All right, time now for ETF Friday. Bloomberg's Ritika Gupta has taken a look at some of those flows, and it's been a really intense, long week, Ritika.
Yeah, Alex, it has been a really intense week, so let's see how that transcends into some of those ETF flows here. I'm looking at the biggest weekly outflows here, and you can see, no surprise here, it's coming out of equities, out of IVV. $4.6 billion of outflows, SPY $2.9 billion, and of course, tech bearing the brunt. You've got your Qs here minus $1.7 billion of outflows as well here, and TLT also getting hit here, and this is on a week where we have a sell-off in both equities and bonds here. But let's talk about another theme, and that, of course, is investors turning their backs on some of those tech names. And we can see that by looking at Cathie Wood's flagship ARC fund, which actually had its first quarterly outflow ever. And this is as investors, they are nervous about higher inflation, higher interest rates, how it is going to hit some of those tech names, particularly at such elevated valuations here, Guy.
Absolutely. Inflation is the story. We're all paying attention to it. Are we starting to see that being reflected in positioning in terms of the hedging that we may be taking on? Is that showing up in the flows?
Yeah, Guy, we have seen inflows into some of those inflation-protected securities. So the likes of your ETFs, TIPS and IVOL, for instance, seeing $1 million of inflows this week. But also, if you look on a year-to-date basis and we kind of extend that out, we're actually seeing a record amount of inflows into these types of ETFs, over $25 billion worth there. That is double the previous record that was set last year, Guy.
Really good. Thank you very much indeed, Ritika Gupta, on what we're seeing in the ETF flows. Let's take a quick look at what we're seeing in these markets. Alex, equity markets don't seem to be able to make, in fact, broader markets don't seem to be able to make up their minds right now which direction we should be heading in. We're up, we're down, we're up, we're down. I guess we're watching what the data is telling us. We've got a new quarter to deal with, and we've got DC, which, to be honest, is pretty much the same.
Also, did you read the article that came out late yesterday about a huge options trade that came on for the S&P that's basically positioned for 3% upside and as much as 20% downside by the end of the year? Same story in terms of, say, retail traders. They're buying less calls and they're buying more puts. Like, the mood music has definitely kind of shifted. And now I think the question becomes, as we go into earnings season, what is priced in then at those levels? Like, are earnings downgrades for 2022 priced in? Are disappointments like we saw, say, with Bed Bath & Beyond yesterday, are they priced in? That, I think, is now kind of coming to the fore.
I don't know the answers to those questions, but what I do know is that what I'm seeing every day now appears to be a sell-side capitulation. The number of notes that seem to be sort of coming out right now, talking about the fact that we could be seeing significant downside, even of the scale that you're discussing, seem to be growing. I think what was the latest one today? Bank of America on European equities, 10% down by year end.
Yeah, but then that was Sebastian Radler of B of A talking about that as well. I mean, no surprise after you've had European stocks looking at its worst week since January. I mean, it's been a really bad week. The quarter or the month, one thing, but it's been a tough week over there.
No, it has. It's been a really tough week. And as you say, earnings season is still coming. We're still trying to figure out exactly what the gas story is going to mean. We've obviously had that impacting European industry already. You can see it already showing up in the PMI data. We got an update there. And again, this kind of narrative that seems to be coming out of market at the moment about stagflation seems to be growing ever louder. The UK just feels like a microcosm of this at the moment. There's article after article talking about a return to the 1970s, which wasn't a particularly good period for the UK.
For anybody.
No, but the UK in particular. The winter of discontent, 1979, that was a pretty grim period. So we're going to be paying attention to this data, the shortages, the bottlenecks, the energy story.
You were like 9.
At the end of the 1970s.
I'm just saying.
I was born at the beginning of the 1970s,
I know, you were like
which
9
does
years
in
old
some
when
ways
the
make it a great
discontent
decade.
happened.
Anyway, Joe Gilbert's coming up next. We'll discuss this with him. This is Bloomberg. From London, I'm Guy Johnson. Alix Steel is over in New York. This is Bloomberg Markets. So let's talk about those markets. We've come through a turbulent September. We now deal with October, which is going to deliver a lot of earnings, and we're going to have to figure out exactly what kind of areas we want to focus on. But clearly, what is happening with the supply chain story, the inflation narrative, Alex, is going to be critical, because that's going to be at the center, at the heart of this issue. Can companies... We were talking yesterday about this with RBC. Can companies continue the narrative that they're okay with this, that they can manage this?
Yeah.
Or a few going to start saying, you know what, we've got a problem here? That was the question that Lori Calvasina was raising yesterday.
Yeah, and sort of, like as I mentioned, that options trade coming on with some bets coming in and some nervousness about what the downside could be over the next 3 months. Let's get some more detail here with Joe Gilbert, Integrity Asset Management Portfolio Manager. Joe, I was talking earlier about this big options block that traded yesterday that could protect to as much as 20% downside by the end of the year. Are you in that camp? Are we seeing capitulation this sell side? Like, here we go?
Alex, no, I think ultimately that is a good setup for the market, because you want to see a little bit less complacency, which I think, when we were at the beginning of the summer, June, July, there was a lot more complacency in the market. So the fact that we have individuals that are trying to position themselves for a greater downturn in the market actually gives me a little bit more comfort.
So where do you think we go during the quarter? Do you want a position for the market to be positive? Do you want a position for the market to kind of go sideways? Do you want to position, or do you want to hedge? If you believe in that, do you want to hedge the downside at all?
No, I think that's a great question, Guy. I think what you really want to do is, as we're looking through, we came through the summer and we kind of have a lot of seasonality. September historically has been a pretty bad month for the markets generally. October has been known to also be a little bit more volatile. And then we end up with November and December being a lot stronger, i.e. the Santa Claus rally. So I think that we're still following the same seasonal patterns here, but you have a lot of underpinning of stronger economic growth. And I think that ultimately earnings are going to be surprised to the upside because I think that a lot of people have, a lot of the names have de-risked going into it. A lot of estimate revisions have kind of come down because it's kind of uncertain as to what the supply chain impact will be, but I think it'll be manageable.
Oh, that's interesting. Lori Calvasino was talking about that some of the big players were sort of dipping their toe in industrials because earnings estimates have come down so much. Where do you see those opportunities?
No, I definitely think within the industrials that is where, that's kind of like the epicenter of where a lot of the supply chain disruptions are most impactful because these are companies that have huge operating leverage, both positive and negative. So I think within that, you have like your machinery names and the trucking names. Those are names that are going to actually benefit pretty strongly from this recovery. I think so right now what we have is a little bit of pricing pressure in there, but what has happened is you still have the volumes to an extent. So I think that we will be able, the numbers have come down, so the expectations aren't nearly as high. Happiness is always a function of expectations. So I think that as long as the expectations are low enough, the bar that these companies will outperform and beat the estimates out there.
Joe, energy just continues to knock it out of the park. How much longer can that continue?
Guy, right now we haven't reached the point of demand destruction, and with consumers having a lot of savings still, and companies still pretty flush with cash. It's kind of one of those things we don't know exactly what that ultimate level will be when you're talking about like maybe crude oil, natural gas. We're probably getting there. So I think that within energy there's still some tail room to run there because there is still a lot of strong velocity within the economy.
And it's sort of a similar question to financials as well. Because the supply chain issues actually may not be as relevant for financials and you still get that cyclical exposure, plus if you have higher yields, how much have they re-rated?
I think that what we had at the beginning of Q3 was a lot of pressure on the names. The yield curve flattened a fair amount. Then that's when you saw the rotation going into technology and a lot of the perceived growth names. And that took a lot of cash away from the financials. So right now, I think that with the financials, with interest rates backing back up, the yield curve steepening a little bit, that gives these guys a little more momentum earnings-wise going into the back half of the year and definitely for 2022.
Joe, if you are worried about these markets, what do you do? Do you want to take money off the table? Do you just rotate into different bits of the market? There's this whole sort of Tina argument, there is no alternative. And you look at the bond market, everybody hates bonds right now. Like portfolio managers just hate their bonds. So what do you do if you are worried about what is happening here? What do you do if you want to de-risk your portfolio?
I think what we've had this year is ultimately has been, I think it has been coined, has been rolling corrections, and it's basically gone throughout different sectors of the economy. So I think the beginning of the year you had a lot of consternation within the technology names. Then you had the uplift with the industrial. Then you turned back into the technology names, and now you have a little bit more footing for the cyclicals and industrial names. So I think ultimately where we want to be is we have to realize that from pattern recognition that there's a great rotation, because I think to your point, there is ultimately, from a lot of investors, there is no alternative. It's kind of, we have to pick our spots and be a lot more tactical about where we think the puck is going to be going. So, and right now that's going to be in the more economically sensitive names and economically sensitive sectors.
So then what's the path of least resistance for the dollar? Because I have been so confused about the dollar the last couple days. You wind up having rate differentials sort of leading the dollar higher, yet the dollar is outperforming certain currencies that are maybe actively tightening monetary policy or going to do it before the Fed, and the dollar is still higher. And I mean, at some point that's going to come home to roost for U.S. equities. So I'm wondering how you're looking at it.
No, I think to your point, I think the bias is for a stronger dollar, especially as the Fed has indicated that there's going to be, they're going to be less accommodative to an extent, still accommodative, but less. And obviously the market always trades off on the margin. So that gives the dollar a strong tailwind. It also does create a headwind somewhat for, as far as earnings go, for the larger international companies. So then I think when we think about that, then it's probably better to be more U.S. centric when you're looking at smaller and mid cap names that will have less exposure.
In terms of the potential for this market to move higher by year end, how would you handicap that? So I'm getting a lot of sell side notes that are saying we think there's going to be a really big correction. We think the market's going to be lower by year end. Like Santa Claus could be one of the only people that is delivering this Christmas. So let's talk about how he delivers. What is it going to take to get this market to go up?
Well, I think if you look at it, I mean, the first thing, we've kind of given back some of the gains from earlier today, but I think you have the news out of Merck as far as, the antiviral therapeutics, that, the oral tablets. So I think that what we have is, we got into this with a lot of shutdowns and a lot of fear. A lot of the fear is coming out of the market as far as COVID goes. And I think that what we have is, every day, as I've said before, every day that we're in this, we're getting closer and closer to a solution. So, and I think when you get a solution to, have people operate in the economy, operating full capacity, people being able to, not being scared to go back to work and go return to the office, I think that really opens up a lot of economic activity that's been, retarded thus far. So I think that becomes that catalyst that projects, propels us further along. And so I think, we've seen the cases of COVID roll over. I think that you get to the point that, the Fed is not going to be nearly as hawkish as people expect. That sets you up for a lot of momentum from within the equity market.
Also, yeah. Guy, you mentioned Santa. Forget it. We're not going to have trees. There'll be no plastic Christmas trees. There'll be no presents because they're all stuck on a port somewhere or they can't get all the things to get them. It's going to be a very depressing couple months.
Great. And Santa doesn't exist, right? Is that what you're saying to me right now?
Well, if he's buying something, he's not buying stocks. Okay, he's going to be trying to buy chips and supply chains in a container. That's what he's going to try and buy.
Hopefully he's going to be delivering all the stuff we're going to need for Christmas, because it's going to be a long list this Christmas. You're not only going to have to deal with that. Joe says he's got to deliver a market rally as well. We'll see what happens. Joe Gilbert, have a great weekend. Thank you, sir. See you soon. As Alex says, coming up, staying with that Christmas theme, GMM, non-stick coatings, just finished their busiest phase of the year for Christmas production. The bad news, their clients have over 100 containers stuck in ports. We're going to talk pots and pans next. We're going to talk supply chains. We may even throw Santa in as well. Ravan Gandhi, GMM's non-stick coating CEO, is going to be joining us next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal. Coming up, U.S. Senator Bill Hagerty of Tennessee. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. House Speaker Nancy Pelosi will try again today to get a vote on that infrastructure bill. It's been held up by a fight between moderate and progressive Democrats over President Biden's economic agenda. Progressives have vowed to stall the infrastructure bill if the House and Senate don't vote first on a tax and spending package worth as much as $3.5 trillion. A new COVID antiviral pill made by Merck reduced the risk of hospitalization or death by 50%. That's according to an interim analysis of a late-stage trial. Merck is halting the study and will seek an emergency use authorization from U.S. regulators. Shares rose by the most since 2009. Supreme Court Justice Brett Kavanaugh has tested positive for COVID-19. The court says Kavanaugh has no symptoms and has been fully vaccinated since January. His wife and daughters tested negative on Thursday. The court is scheduled to begin its 9-month term on Monday. All 9 justices are fully vaccinated. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So let's get back to those supply chain issues. They're hammering industries Around the globe, we saw it in the ISM as well. DP World CEO spoke to Bloomberg's Manus Cranny at the Dubai Expo, and he says the issues are here to stay.
It's not just the freight rates. You can't find an empty container. Empty containers are a problem. We are buying containers for our customers because we have many customers who are looking for containers. So freight rate is continuing to increase. The shipping lines is having an amazing time now.
Jebel Ali, one of the top 10 ports in the world. He's been doing that job for a long time. He knows what he's talking about in terms of what we're seeing with global freight. Let's carry on the conversation. Ravin Gandhi, GMM Nonstick Coatings CEO, joining us now. GMM Nonstick Coatings, one of the world's largest suppliers, as you would expect, of non-stick coatings to the $9 billion houseware industry. Ravin, we were talking about Christmas just a few minutes ago, so let's talk about Christmas, because I'm really curious, because you guys have to have a lot of visibility about what is happening. We're all focused on supply chains right now. You are probably laser focused. If I want to buy my wife a new frying pan for Christmas, when does that pan get made? Where does it get made? When does it get on a boat?
So I'd say 85% of this multi-billion-dollar industry is largely made in Asia and primarily in China. And we typically start getting busy for Christmas in June, and that goes through about September. So anytime in that phase, depending on if it's a piece of cookware, bakeware, or a small appliance, it could be made usually in that range.
First of all, Guy, please don't do that. Do not buy your wife a frying pan.
There is a simple rule in our house. I joke about this. It's more likely that I will get bought one. If it has a plug on it, I'm not allowed to buy it. If it is a piece of cookware, I am not allowed to buy it either. Those are the two simple rules.
Okay, those feel simple.
As long as you stick to those, you're absolutely fine.
Okay, Ravin, but the idea is that if you wanted to buy one of those frying pans for the holidays, you may be under some stress. And I want to get an idea from you on to where of the supply chain you're seeing the most stress. I know you're going to say everywhere, but is it on the factory production level? Is it the shipping? Is it the distribution here? Can you rank them for me?
I would say for us, it is shipping number one. Between our large American clients, we have people that have over 100 containers sitting at various ports and factories because they either can't get a vessel due to scarcity. COVID regulations are changing crazily in China, and cost. We this year have seen cost for a container from Hong Kong to the States go from $1,500 to $15,000. 10x. So that's crazy. So I would put that at number one.
Let's assume my wife wants to buy a new frying pan for me, how much more is she going to pay this Christmas versus last Christmas, do you think?
So we have raised our prices between 15 and 25% to our clients this year. That's come over 3 different tranches. And normally I am loath to raise prices at all. But the fact that we've had to do it 3 times this year speaks to the fact that we've been getting raise after raise from our key raw material vendors. I've never seen anything like this from an inflation perspective. In my view, all of that price increase, it's going to end up at Amazon, it's going to end up at Walmart, it's going to end up at Target, which of course hits the U.S. consumer. Now, it's above my pay grade to predict how much that my clients are going to pass that on to the consumer, but I think a large component of it, they're going to.
Have you been able to pass on 100% of the cost increases?
No, absolutely not. We are in a very, very competitive industry, and so it is. We're kind of at the front line of capitalism, so there's absolutely no way to pass on everything. And one of the things that we do is, we have dozens of these R&D chemists sitting around formulating all the time. We try to use innovation and use fine novel raw materials to take cost out in some way while keeping quality high. 40 million people every day in America use my products, so we are obsessed with quality. But at a certain point, we will have to keep passing this stuff through for sure.
Is this going to be? How long do you expect this to go on for?
I mean, we normally get about 6-month order visibility from our clients. Right now, it's down to 60, in some cases, even 30 days.
Wow.
So it's really hard to run the business. But we're gritty. We're going to figure it out. We've dealt with this, not this bad, but we've dealt with it before. And fundamentally, look, people need to eat. So we know that our market has to go on, but it is really, really challenging. We have a couple operations in Asia. We have an operation in India. We have operations in Europe. So it's juggling a lot of balls and keeping a lot of stuff in the air right now.
Yeah, Ravin, you know, the overall feel is that, yes, the price increases and the supply chain issues will at some point be temporary. We don't know how different temporary means, 12 months, 18 months, et cetera. I'm more interested in sort of what your thinking is going to be after the fact. Are you going to put more plants in the U.S.? Are you going to have larger inventory and warehouse builds for your customers? Are you going to be more proactive in increasing prices? Like, what's the long-term psychological effect for you and how you do your business?
So like I said earlier, the vast majority of our industry is produced in China. When I started my business in 2007, I had to build an operation in China, not because I wanted to, because that's where all of my American clients were. Now, China and the US, that relationship was radically different when I started this business under the prior leader of China. I don't think that I could start my business today, just given what is going on in China from an authoritarian perspective. So in the long run, I would be extremely happy if I could build a operation in the States. The question is, will I be able to produce the coatings for those pots and pans at an economic level that still allows me to get business at Walmart, that still allow me to get business at Amazon? Because if Americans are addicted to one thing, it is low prices.
Yeah, you wonder whether or not that's ultimately going to have to change. Sorry, carry on.
The other thing I would say is that I mean, this U.S.-China relationship is, I think, clearly going to be the big story in the global economy for the next decade. I feel like the housewares industry has just seen it, because we all watched our clients get offshored in the 90s, and everyone thought it was this economic utopia. And so we all rushed over to Asia. And as the China tariffs started happening under the prior president, we had an operation in India that started going gangbusters. Our sister company is putting up an operation in Malaysia right now. So we're seeing a scrambling of China. A lot of those factories are getting pushed to other places in Asia. We aren't seeing it come back to the States, but I am I'm a very patriotic guy. I would love to start building in America if we can, but it's all about the capitalism.
Ravin, we love talking to you. It's been way too long. Thank you so very much. Really on the front lines of capitalism, as you said. I'm Ravin Gandhi, GMM Nonstick Coatings CEO. And coming up, the charts that caught our eye this week. Guys, is more awesome than mine. I can already tell you that, but definitely stick around to watch it. This is Bloomberg. Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. So every Friday when Guy and I are both here, we like to do sort of our favorite charts of the week. And there was so many to pick from when it comes to the energy and gas crisis, but I wanted to take a look at this particular one. This is actually a chart of the dirtiest coal you can burn and their prices. It's from Indonesia, and you can see the massive spike that we've seen despite the fact that it's among the dirtiest. Last year, we saw prices as low as $20, $25 a ton. Now we're looking at like $135 a ton as of this week. And this just goes to China's point. They just want the energy no matter the cost, and AKA potentially no matter what the environmental impact is going to be through the end of the year. They're really into decarbonization. This isn't cutting it, Guy.
No, it isn't cutting it. It's interesting to see what they're saying about coal at the moment. They're not going to build any external, but they weren't really doing any external coal plants anyway. So when do you get to see the Bond movie?
Oh, I don't know. Maybe next weekend or the weekend after. I'm thinking about calling out next Friday just to go see it.
That would be, in my view, that would be a perfectly legitimate thing to do. I get to see it tomorrow. I'm taking my eldest son and some of his friends. It's a kind of birthday treat to see the Bond movie. We're all super excited about it. It hasn't been out. Obviously, it's been heavily delayed, so we've been waiting to see it. The last one, I have to say, I thought wasn't great. So I'm excited to read the reviews that this one is significantly better. The pictures that come with my chart are so much better as well than Alix's.
I know, it's true.
You got an Aston Martin.
What is your chart?
Anyway,
you just put some lines behind you and played the trailer.
That's all I got to do, really, here, isn't it? So this is Cineworld. This is basically the Bond effect. that is showing up in the market. So Cineworld has been battered during the pandemic, obviously because people can't go to the movies. However, the market is basically front-running Bond, which is something you really definitely want to do. And Cineworld is climbing. I took a look at the A&R function, 2 buys, 6 holds, 2 sells. But the average price target is 98. We're at 77 now. 30% upside potentially on this stock. Bond is potentially going to work its magic on Cineworld.
You win.
We're going to back to the energy story next. This is Bloomberg.